Hello everyone and welcome back to my YouTube channel. It's been a hot minute. It's always a hot minute. Anyway, if this is your first time watching my videos, my name is Tumelo Modipa. Welcome, enjoy, stay for a little while, grab some popcorns if you wish, and enjoy this video. Today's video, like most of my videos, we are going to talk about money. Please remember that my money videos do not serve as financial advice, and if you require the services of a financial advisor, please check in with your bank or a registered financial advisor. The reason I do these videos is a whole lot of what I've learned, what I've observed, and a lot a lot of what I do. So don't get me wrong, I'm not a financial advisor. So in today's video, let me just get right into it. So times are really hard right now. The cost of living is rising, but our salaries, for most of us who only depend or have one source of income, which is the salary, it's remaining the same, and everything else is just outrageously increasing the prices. So with your salary remaining the same, and maybe if you do have a little left over, you're wondering, how can I best put away this money to have the greatest benefit in the difficult times that we are in? And in today's video, I want to talk about one way of saving that could potentially yield, if not the greatest, if not the best, but a good benefit. So today's video, we are talking about tax-free savings accounts. In short, you could just say TFSA. So you would obviously want to know what tax-free savings accounts are. And as in their name, they are literally just that. But of course, me saying that does not really explain what they are. So tax-free savings accounts are basically just any investment, not just any type of investment, but it has to explicitly say that it's tax-free. So it's an investment that when you put away money, this interest or anything that it yields, that is being interest. If for instance you have a tax-free investment account, let's say investment dividends, tax-free shares, if you have tax-free shares, then the dividends that you would earn on those shares would be tax-free. The other thing is dividends, capital gains. Also, if you receive any capital gains from those shares, then when you sell those shares, then the profits would be tax-free also. One of the reasons why this tax-free was started or was introduced, which was really a few years ago, was to encourage people to save their money. Because think about it, why wouldn't you want to save your money when you know that whenever you do get it, it won't be taxed? With these investments, what happens is you can obviously get them from your licensed financial institutions. So you can't just rock up anywhere and be like, I want a tax-free account. So the most common places to get these tax-free accounts are directly with your bank, asset management companies. Your asset management companies include and are not limited to, let's say, your Allen Gray perhaps. One of the other one that I like using, which I've also spoken about on this channel, is your easy equities. So your easy equities, you have different portfolios, if I may say, which is you would have your normal shares, and then you would have a portfolio that is explicitly for tax-free savings. Usually I think that portfolio is mostly made up of ETFs, so you'd buy tax-free ETFs. But I will not go deep into that because I'm just trying to brush over the concept of what tax-free savings accounts are, and not like literally one by one try to now deal with different other things. But of course, with a lot of things, there are T's and C's, so terms and conditions. And in terms of tax-free savings account, there are two things, which is your annual limit and your lifetime limit. So annual limit runs between the period 1st of March to the 28th of Feb. So over a 12-month period, which is from the 1st of Feb from the 1st of March to the 28th or 29th of Feb. So it literally runs the same way a tax year does. And then the other thing is the lifetime limit. The lifetime limit is basically almost like the total amount you can contribute into your tax-free account, which is 500,000, and the annual limit is 36,000 rands. So it used to be 33 and then it increased to 36, but the lifetime limit still remained the same at 500,000. To enjoy the greatest benefit with a tax-free account is, in my case, if I were to make use of a tax-free account, which I actually am making use of, is to save for long term. That would be saving for long term, is not saving to use next month or saving to use in the next year, but it would be for a much longer term. For instance, saving for retirement. Why? Because when I actually really do eventually decide that I want to withdraw the money will come to me in its purest form. That is, no interest will be charged, no tax will be charged on the interest. If it's shares, no dividend withholding tax will be charged. Basically no tax will be charged on that money when I do decide to withdraw it. But the other thing to look at, like I said, that there are terms and conditions. If you do decide to withdraw, let's say life happens and you decide to withdraw from that tax-free account. Side note, do not, yes I did wink, do not use a tax-free savings account as an emergency account. Have a separate emergency account that is easily accessible and have your tax-free savings account separate. Please do not use a TFSA as an emergency account. So I was still trying to explain the concept of withdrawal. So if you are trying to withdraw the money from your tax-free savings account, what happens is that the money that you withdraw eats up your limit. So if, let's say, in this year you decide to withdraw 10,000, maybe you had already saved 10,000, so that already eats up into your annual limit, which means if you had contributed 26, right, you would have been left with 10,000 to contribute to get to the 10,000. But if out of the 26 you withdraw 10, you are still left with only the 10 that you initially were left with to contribute towards the 36. So when you withdraw, you don't go back to almost to zero. No, it eats up your limit. So which means then your annual limit also reduces from 500,000 minus the 10,000 that you withdraw to now 490,000. So you see, because you're withdrawing, you are also just reducing now the benefits that you would have been receiving. So withdrawing from a tax-free savings account without a reason really is a big no-no. And I would, let's say, because of big no-nos, here are my big no-nos, how you should not use a tax-free savings account. So I actually already spoke about this. You should not use a tax-free savings account as a way of saving for short-term investment. Use it as a vehicle to save for long-term so that you can reap the greatest benefits when you actually do withdraw that money. Yes, like for instance, to get to the annual limit of 500,000 and you are religiously contributing the 36,000 every year, it should take around about 15 or less years. I think it's 14 years. I would have to calculate that, but I think it's 14 years. It would take you those number of years. So don't use it as a short-term investment. Don't use it as a savings account for the next girls trip. Don't use it as an emergency savings account. Yes, do have emergency savings account, just in a different account and not a tax-free savings account. The other thing is, I think this also, it goes back to when you want to withdraw your money. If, let's say, the reason you're withdrawing your money is because you're not happy with your current service provider, what you do is you do not withdraw the money, but what you do is you make a transfer between two service providers or two accredited service providers that are allowed to, provide you with a tax-free savings account. But obviously that transfer, you don't do it the same way you do an ordinary payment. You have to fill in transfer forms, so that way that the withdrawal is not seen as just an ordinary withdrawal, but it's seen, that transfer is not seen as an ordinary withdrawal, but it's seen as a transfer. Now that I'm remembering, I did a video about stash. So the money that you put into your stash account is actually put into a tax-free savings account for you. So which means then, don't use stash as an emergency savings account, but use it as a way to get you to, increase your annual limits to eventually help with your lifetime limit. So definitely stash is part of, those vehicles that help you contribute towards your tax-free lifetime limit. The other thing that I would like to touch on before I finish with this video is, let's say, what happens if you contribute more than the limit, let's say the yearly limit. What would happen is the amount that is in excess of the 36,000, let's say you contribute 37,000 instead of the annual prescribed 36,000, what would happen? So the 1,000 rand would be subjected to penalties, and the penalties are 40%. So if you contributed 1,000 rands extra, the penalty would be 1,000 multiplied by 40%, which is literally 400 rands. That's what I wanted to say. The last and final thing that I would like to discuss or just bring to everyone's attention is, the nice thing with having a tax-free account is that you are not limited to having only one. You can have multiple accounts. It's just you need to be wary of the fact that when they add up all those accounts, they need to not exceed the annual limit. So for instance, you could have a tax-free account with your bank. You could have a tax-free account, let's say if like myself you have stash, then it would be one with your bank, one with stash, and then with easy equities, that tax-free portfolio. So if you have, let's say, those three, you could definitely have 7 if you want. What you need to be cognizant of is the fact that when they add up the money that's in my tax-free account or in your tax-free account with your bank, plus the one in stash, plus the one with easy equities, plus maybe the one with another investment management company, the money needs to get you to 36,000 and not more. So if the money from all those accounts is above the 36,000, then obviously the excess outside of the 36,000 will be the amount that is subjected to the penalty of 40%. And I hope this video was helpful. Do engage with me in the comments, and I'll see you guys in the next video.